Hello, everyone. Welcome to a Wall Street for Main Street podcast. My name is Mo Daoud, alongside Jason Burak. And today, instead of interviewing a guest, we're going to recap on what's been going on the past few weeks regarding the economy and the stock market. So, Jason, thank you for joining me.
Thanks, Mo. Glad to be back, and hopefully we're going to cover as many topics as we can in the 30 or 40 minutes we're going to be doing this podcast for. I think the main topic, Mo, that I think everyone wants to talk about now is the no taper. And the mainstream, all the Keynesians, all the Wall Street robots, they were 100% adamant that there was going to be a taper. And I was just arguing with these. I comment a lot on Seeking Alpha on investing articles on stuff because that's where a lot of Wall Street guys and hedge fund guys post, and they also check those articles often. It's a good way of interacting, getting sentiment gauge with the whole professional investing community on their Mo. And these guys were adamant. They were writing articles for months about the taper, how we have to taper and all this stuff. And we've been saying that the Fed's not going to taper, but if they do taper, they're going to have to reverse course anyways, and that's basically exactly what happened. They ended up not tapering.
Yeah, and looking at the economic numbers, I mean, there wasn't enough for them to justify doing a taper. I mean, spending is down, not enough jobs being created, and GDP growth is not where they want it either. So if you look at all the economic numbers, they just no reason for them to do the taper. And also, if you look at the balance sheet of the Federal Reserve, it's over $3 trillion and counting. And I don't think the mainstream media and the experts understand the implication of how big their balance sheet is and what damage it can do to the economy if they start to taper on the QE.
Yeah, a few more points to add there, Mo. What I would say is that the Fed, the Keynesians want a higher inflation rate. So why would they stop taking the inflation out of the system? So that's number one, right? Because they're not getting enough inflation, right? So they want more. Right. So that's number one. Number two is the wealth effect, right? They've paid people many millions of dollars, academics and researchers and stuff, to write these for over a decade, to write about the benefits of the wealth effect throughout the entire economy. So why would they allow asset prices to crater, right? Why would they allow real estate prices and stock prices to collapse? Okay, so that they would be intellectually bankrupt then to allow that to happen if they've spent all this time, money, and effort talking about the benefits of the wealth effect throughout the economy. So I think they were more just trying to jawbone the market so people wouldn't start massively leveraging, on margin, all stocks, all real estate, all these other types of things, thinking that there was no possibility of any type of correction in any of these markets. So that's one other point. And the other thing about the taper that I really think was ridiculous is that the jobs. It just has not created any of the jobs, really, that they thought it would.
Yeah, and a lot of it goes into high taxes, high regulation, and just the economy, just not a lot of uncertainty also as well with what's going on in Washington, D.C. regarding the debt ceiling and the budget and etc. So just too much uncertainty for corporations to expand and start hiring again. And I saw a graph on zerohead.com, and I'll post the link below our interview. And there's a chart that shows the corporate profit, and it compared it to the percentage of U.S. population with a job. And there's a big divergence on that chart. And it's a good example of the wealth transfer you've been talking about. Ever since the Federal Reserve started the QE program, you can see on the chart that the corporate profit has been climbing and climbing, but yet the percentage of U.S. population with jobs had gone down. It's gone down from just about 60%, 62%, all the way below to 58.5%. So it tells you that the wealth effect that's going on right now.
Exactly, Mo. And back to one more point there about the taper. I just remember this. The other reason the Fed really can't taper that much is because Japan and China are humongous net sellers of treasuries since the Fed announced the taper. Since the Fed announced in April and May that it would consider starting to taper, right? March, April, and May then. And basically the taper's already been priced in, so they can't do another taper because the interest rates on the 10-year are already up a lot since months ago, and you have humongous net selling of the U.S. Treasuries now by foreigners. So the Fed is spooked. It's worried the interest rates will rise too quickly and crash the economy. Now back to the other situation there. You talk about the wealth transfer. The thing about inflation, it does not destroy wealth. It transfers it. So the inflation benefits DC, it benefits the politicians and the bureaucrats who get all these budgets. They get to spend the inflation money first, right? Their budgets go up every single year no matter what. They blow through their budget. They don't keep a surplus like a prudent business or individual or family would, right? It's smart for a family or individual or corporation to keep savings on the side, right, for emergency. The government doesn't do that. It burns through everything and thinks it can find new ways to generate revenue through taxes and other schemes. So all inflation is really is a wealth transfer. It transfers the wealth from the people who work their ass off at their job, and then also the middle class and savers, and it transfers their wealth, their purchasing power, to DC, to big government, to Wall Street, and to large corporations who can all borrow cheaply. And this benefits people who have a lot of assets already. They get even richer off inflation, because they have the financial intelligence to know that the inflation is there already, despite what the stupid government statistics say, and they're going to invest accordingly. And that's why, Mo, I think you're seeing this rush of flight capital out of China, out of Europe, out of the United Kingdom, and it's going here into the U.S. for all-cash deals, and it's going into the large-cap dividend stocks and things like that.
Right, and let's not forget that throughout history, the only group of people who create inflation are the government. It's not corporation or the people that create inflation. If you look at history, it's always the government that's been responsible for massive inflation in the economy, because they're the one that control the money supply. So, and they want the inflation because they get more tax revenue from inflation, so they can keep spending as well.
Exactly, Mo. Exactly. Now, we wanted to talk a lot about jobs and some of the things going on in the jobs market in this podcast. So let me just summarize something. I'm having kind of a call-in debate on the Q calls with Jim Poplava, Financial Sense Newsletter. I love Jim Poplava. I've learned so much from his program, so much from him personally. I'm friends with a lot of the guys over there at PFS Group. I speak with them in emails quite a bit. And he's just saying, Mo, about all these jobs that are being created, that are being brought back due to manufacturing, these higher-paying jobs, the shale boom, how America is recovering. And these individual sectors, I want to be very careful with my words here. This is why I'm going to be very careful. I think these individual sectors, they may be doing very well, especially shale energy, technology, some of these manufacturing, those things, but there are not enough jobs to go around for everyone.
Right, and if you look at what the fracking has done for this country, it has created a lot of jobs, and many people think manufacturing would come back to the U.S. because now we can create oil now, and
Yep.
energy costs here will go down, so it would make more sense for manufacturers to come here and do business, which may be partially true, but all the jobs are not going to come back to the U.S., mainly because it's automation and robotics that's replacing these workers. So it's not like the 1920s where everything was done by humans. There's a lot of automation and robotics that's replacing people now, and it's going on worldwide, not in the U.S. only.
Yeah, now let me just provide some more color to this for our listeners, and these are some numbers. Okay, since after the 2008 crash and the market crisis, over 7.5 million jobs have been created according to the Bureau of Labor Statistics, Mo. I have a problem with that number. I think a lot of that total number has been assumed and those jobs have been created out of thin air by the birth-death model from the Bureau of Labor Statistics, which assumes that every time one job is destroyed in the private sector, another one is automatically created. I think what we're seeing, Mo, when we look at the jobs information is that the labor participation rate is the lowest it's been since I think 1978, Mo. And
Yep.
yes, so it's over 30 years, humongous amount of time. And that means a lot of able-bodied males, people in our demographic or older, want to work and the jobs are not there. So let's now talk. There's, like I said, there's a lot of part-time jobs available out there, but you can't really have a good life just on a part-time job. You can.
Yeah.
Hmm?
I'm sorry. Go ahead.
Yeah. So what I would say is, yes, there is jobs being created in shale oil revolution. These are in specific small areas of the country. So Texas and North Dakota, in terms of the actual statistics, they have created 18% of those total jobs. So those are all shale oil and service-related jobs. So those are the jobs that are either you're doing the fracking, you're related to a service sector, you're driving the trucks for the fracking water, the sand, or things like that, or you're helping manage the restaurant or the hotel or those things in the towns where that's occurring. So that's the multiplier effect that Jim Poplava is talking about. That's good overall for the long-term health of the economy. That makes us more productive, et cetera, et cetera. And the cheaper oil and gas will bring manufacturing jobs back here to the United States from other factory countries, like you said, Mo. I agree with that too. The problem is I don't think there's enough jobs. Jim Poplava is way over assuming. He's making humongously bullish assumptions about total number of jobs from the multiplier effect, where if I build a factory here, right, Mo, for like $1 billion or $2 billion, right, and I put in all robots, right, it's almost all robots, and there's only a couple hundred highly paid engineers or software guys, right, who are testing the robots, repairing the robots, checking the software program to make sure the robots run on time, et cetera, right? There's only 500 or 1,000 direct jobs. Whereas in the past, there used to be many, in China, Mo, isn't there like, at some factories, there's over 500,000 factory workers. So that's, yes, these are more value-added factory jobs, but when there's, many millions of people out there looking for a full-time job, a couple thousand highly skilled jobs, Mo, that pay a lot of money they're good for the long-term health of the economy. They make us more productive. They will lower prices for consumers, probably offer new technologies and things like this, right? But they're not going to solve the problem of, I would say there's at least 20 or 30 million young adult males in the United States who would want a full-time job, and they can't find one.
Right, especially in states like California and New York, where there's just a lot of high unemployment, a lot of businesses that are leaving the state and going to business-friendly states like Nevada, Colorado, Arizona, Texas, Florida. And so, yeah, a lot of the younger population in California are struggling, and, they don't have any fracking boom there. They have the technology, big, Silicon Valley, but all the manufacturing jobs are overseas. They don't make any of
California
stuff.
California could have a fracking boom, Mo. They have the Monterey Shale there, which is a humongous amount of shale oil, and offshore Santa Barbara, there's billions of barrels of oil. The environmentalists just won't allow it. So again, this is a problem, Mo, not created by the free market. It's created by governments, and it's created by bureaucracy and central planning and things like this. People who try to fight the market and hate the market.
Yep, and even overseas, they're replacing the manufacturer workers with automation and robotics. Foxconn had planned to replace a lot of their workers with robotics. So I think the automation and robotic boom is that's not gonna affect this country that much in the U.S. But in emerging countries like India and China, I think the robotics can have a big impact on employment there.
Exactly, Mo. I think it's gonna create lower prices for consumers all over the world. 3D printing, big data, which allows you to look at large amounts of data and find correlations. I just finished a really good book on big data this past weekend. I finished it over the last week or so, and they can find amazing things in large amounts of data now. They can find amazing correlations that make businesses run more efficiently, that allow them to sell more products and services and things like this. In a more efficient way. It'll help with advertising, that's for sure. But it's not going to create millions of jobs, okay? So it will lower prices for consumers, which is a good thing. But these technologies, Mo, like 3D printing, robotics, big data, software, applications, biotech, they're gonna really help make the world more productive, more efficient, things like that. but they're just not going to grow jobs. But people should invest in these technologies. Now, these are not value stocks, but these are growth stocks. And I think, Mo, regardless of whether the economy goes in the toilet further, and as our listeners know, we expect worsening stagflation, as long as all the global central bankers who are all using the same Keynesian playbook to continue to intervene in the market, we expect worsening stagflation at best. I think these technologies, Mo, are still going to continue to adapt and innovate and evolve and change, because these things are disruptive. I mean, look at 3D printing at how much it's going to reduce the cost of manufacturing. And robots are not exactly advanced yet. You know, we have some very limited robotic technology. It has improved a lot, but I mean, we're not to the level where we can do the stuff. The 3D printing technology is just amazing.
Oh yeah, definitely. And you know, in a free market world, having robotic replace all of these manufacturing workers is not exactly a bad thing, because all these manufacturing workers could learn new skills and maybe become robotic repairmen, or do robotic maintenance or something else that's in high demand. So, you know, even though these robotics are on the rise and they're replacing the manufacturing workers, these workers can go out and acquire new skills and take advantage of any new trend that's going on in the economy. So a lot of people have a big problem with the robotics, and I hear a lot of complaints that's going to be bad for a lot of the manufacturers.
It's bad. It's bad if you're a worker, Mo, and you have a huge debt load, like you took out humongous student loans to learn how to be like a technical school, how to like learn manufacturing skills or those things. But if you don't have a humongous amount of debt and you saved a good amount of your salary, so you didn't go spend all your salary on a whole bunch of new consumer purchases like a boat, a house that's too big for you can barely pay the mortgage payments, those types of things. That's the problem with society, Mo, is it's not adapting fast enough to how quickly technology is changing and changing the economy. So, and then on top of that, we have people who are way over leveraged. So there's just too much debt on the public sector, the private sector, and at all levels of society.
And I agree there. And going back to 3D printing, I believe you said many times in the past that 3D printing is in a bubble. So let's talk about that. Do you think 3D printing is still overvalued, or is there something that investors should go out there and take a look at for growth?
Well, I don't know if it's in a bubble, but the thing is, all these technology stocks tend to act like bubbles, even like Netflix and Tesla and things like this. Like Tesla's valuation, it's already priced at HBO. The 3D printing stocks are in an industry, unlike Tesla, unlike Netflix, that's actually growing very rapidly in terms of revenues per year and earnings per year. The question is, what multiple is the market going to pay for those earnings? You know what I'm saying? For the growth?
Yep.
Yeah, the question is the multiple. So what I would say is I don't think I've said that 3D printing stocks are in a bubble. I think stocks like Netflix and Tesla are way worse because those are not huge growth industries, and the assumptions that the market has made, those are good companies, but the assumptions the market has made for some of those valuations are just ridiculous. But there's plenty of ways there's only 3 or 4 3D printing companies out there because the 3 or 4 that exist have bought in terms of pure plays. Now, there's probably larger corporations that have a smaller 3D printing unit, but there's only 3 or 4 3D printing pure plays that are actually making any money right now, and those guys are buying up all the patents and buying up all the little companies to protect their market position. You could hedge the portfolio, so you could buy those stocks, and you could just hedge yourself on the downside with options and stuff like that. So I don't think that obviously you shouldn't buy all of your position at once, but over the long term, I mean, these things are gonna continue to grow. I expect with the technology in 3D printing, they're already making like actual physical goods, like they're making things out of plastics and resins and things out of different types of metal. They're eventually going to be printing organs. You read the stories in the mainstream financial press how so-and-so company, like all the toy manufacturers, Mo, they used to use plastic injection molds, which were really crude. You know how the Happy Meal toys used to be ugly? About 10 or 15 years ago when we were growing up, some of them, like, they would have, like, our favorite cartoons on, and then you'd go and get the Happy Meal toy or whatever at, some of the toys in, like, the toy store, and they wouldn't look anything like the character. And that was because they couldn't get the facial features right because of they were using really crude plastic injection molds, which are something that have been used for many, many decades, right? And now with 3D printing, they can use laser etching, so they can get almost every little detail perfect now. And that's just revolution. It's very detail-oriented. It's very efficient. You can make one model now for a lot cheaper. You can make one model now. Before you start mass manufacturing something, you can make it way cheaper than you could in the past. And it's getting so even the common man now, middle-class person, can buy a 3D printer. I believe they're below $2,000 a unit for a pretty solid one, a used one. That's about in the new.
And it's going to be interesting how 3D printing and big data and automation, robotic, how they will change the economy going forward.
Yeah, I mean, exactly, Mo, and look at the stuff that software and apps have already accomplished. I mean, we used to have those big bulky GPS units in our car. I still have one. It sits around here, and I hardly ever use it, right? And if I want to look up directions now, there's Google on my smartphone. There's Google Maps on my smartphone. There's a whole bunch of other apps I can use, right? So I don't have to bring that big bulky GPS unit into my car if I don't want to, although I actually still like the big bulky GPS unit. But I tend to not use the most brand new technology immediately. I tend to wait a little bit before some of the bugs are worked out. I learned that mistake after buying a brand new version of Windows, and it destroyed my computer a long time ago.
Windows Vista?
Actually, it was my freshman year of college, and I think I switched to Windows XP, and that wasn't my original operating system, and I bought it as soon as it came out, and it just, like, crashed my computer and did all types of things. It ended up being a good operating system after they worked the bugs out, but these guys release now, the new stuff so quickly, they put it out with bugs in it. Yep. So it's just not worth it. I mean, new technology over the long term, though, is just going to be amazing for consumers, and that, to a large extent, I may write an article on this, Mo, either for our email list or I'll post it on Seeking Alpha for our listeners. If they want to go over there, I haven't written the article yet, but I've been thinking about it, is that technology is a huge inflation hedge. So we like our resource stocks, but the more I study technology, because of Obamacare, because of the inflation these people are going to put in the system, if workers are demanding doubling of wages, like in South Africa, for miners, the South African mining unions are demanding that workers' wages be doubled, even though the miners are going to be bankrupt, right, soon, because metal prices are low and their costs are going up. And we're to the point now where to stay in business, they can't raise the wages. Their miners are going to go out of business, so they're going to probably switch to mostly robots to mine. They're going to automate the whole thing. So we're to the point where my whole point, Mo, that I was just saying is that I think technology is definitely an inflation hedge because as costs rise, as labor rises, as inputs rise, I see more business people looking to not necessarily outsource things, Mo, but looking to switch to a software program, like a big data thing, using software to automate things, or switching to robotics and things like that.
Yeah, we're seeing a lot of corporations and businesses looking for a way to become more efficient, cut production costs, and so yeah, the technology industry is one industry to look at if you want to take advantage of that, because in an era of stagflation and inflation, these technology companies are becoming more and more important in the economy because they are the one that try to improve productivity and cut costs and protect their profit margin for all the corporations.
Yeah, exactly, Mo. And you brought up the Foxconn example before we started recording, and what Foxconn's the largest manufacturing facility in China and in the world, right? There's like millions of people who live there, right? And they assemble like iPhones and laptops and tablet PCs and those things, right?
Yes, they do.
Yeah, and in China, as our listeners know, in China the labor costs have been rising very, very rapidly. I believe they've doubled in the last few years, and over the last like 6 or 7 years, they've gone up a lot. They might even have doubled a couple times. So that's a situation where if you're running the company, right, you can't afford, if you're running a marginal factory there where your profit margins are not very high and your costs are going up every couple of years, you're going to look for ways to cut costs. So that would just fit into our example there of how technology and robotics, robotics is a type of technology, how that's going to be an inflation hedge in the future too.
And yeah, with robotics, you don't have to worry about paying them health benefits. You don't have to worry about union. You don't have to worry about them calling out sick or taking vacation, because they're going to be working 24/7 for you.
Or that pension plan that General Motors and Verizon and those guys are burdened with, where they have to guarantee, I think, 9% returns per year or something like that.
Right.
Yeah, that's something else too. So you don't have to pay the robots the pension plan, retirement benefits, and Obamacare and healthcare and things like that.
Yeah, so that's another reason why a lot of corporations are looking at robotics and automation now, because you don't have to deal with the heavy expensive like pension plan and health benefit and etc.
Yeah, and I think Mo, James Altucher, who's a former hedge fund manager, and he's a technology investor, like an angel investor and a venture capitalist and stuff like that. And he said he's on the board of directors at a temp staffing company, and most of the Fortune 500 has contacted his temp staffing company about firing full-time employees and switching them to part-time. So, and I think, part of that solution is not only is it Obamacare, not only is it unions demanding higher wages and things like that, but it's also because there's the technology out there now where you can have in the HR department, for example, right? You used to need like 10 or 15 or 20 people in the HR department, right, to look at applications, right, for new people. But now you can have one or two people manage the software program, right, that scans the keywords and all those things. So for listeners out there who are looking for a job now, your resume might not even be read by a human being until it gets to like the last stage. It's all software programs now and big data and things like that. That's going to scan keywords and key phrases and things like that. It's just all automated.
Yeah, especially when you're looking for a job. When you submit a job on LinkedIn or a company website, go to the database and they look for the keywords, and the resume with the most keyword are the one that get selected to be looked at by the HR department and then get an interview. So yeah, the HR department are not even looking at all these thousands of resumes anymore.
Exactly, Mo. And so it's going to be very that only adds to our stagflation argument. That only adds to our stagflation case. It's just going to be very difficult for and in terms of the actual numbers, there's more than 2 million Americans that graduate high school, graduate college, and immigrate to the United States that want to find a full-time job and can't. So those people, some of them are going to find full-time jobs, but most of them are not. And baby boomers, Mo, are not retiring as often. There's a lot of them are working longer because a lot of them are over-leveraged too. So they're going to stay at their jobs longer. And one last thing on the no taper comment, Mo, one last thing I want to add is that the Fed is actually, and we saw this in a Sprott article, it's called Taper in a Teapot or something. We'll put a link to it in the podcast box after this, but Sprott did some great, Eric Sprott and company did some great research, and the taper, not only is the Fed buying $85 billion a month in mortgage-backed securities and treasuries and those things, but they're actually reinvesting the interest payments on their treasuries and stuff, which are low, but still there's some interest, right? And this varies each month, but their QE program some months is $90 billion, and some months recently it's been over $110 billion per month in QE. So, so for them to drop that low when foreigners are dumping our bonds at record levels, and they're reinvesting and they're doing that, I just don't see it. Now maybe they do a token taper where it was a small amount, and I've said that in the past, they could have done that, but they were going to have to eventually, reverse course, do a 180, and probably end up printing more.
And yes, I think we all three of us, me and you and John, have said on the record that we don't think the Fed will taper, and we were right. And all you have to do is look at the balance sheet, just like I said before. And who knows what the Federal Reserve are really doing back in Washington, D.C., because it seems like they have a hidden agenda, and they don't want people to know about it.
Well, exactly, Mo. And the Fed's not exactly getting audited. I mean, Ron Paul did his best to try, and it doesn't seem like anyone else in Congress is even really trying anymore to get them audited, or at least maybe Justin Amash. but I'm not really aware of anyone else offhand. And the Fed's probably going to end up they're already bailing out a good amount of the European banks. They might have to increase the amount of bailouts that they're bailing out the European banks. They might we saw an article in the last month or two that they may even have to bail out the Chinese banks. So this is just all, and the company line, what they say is that it's just an emergency loan, right? It's just an emergency loan. They will pay it back over 15 or 20 years. It's a low-interest emergency loan, and there's collateral and all that, and it will be paid back. Yeah, right.
Yeah, right.
Yeah, right. Yeah,
Exactly.
right. So let's wrap up the podcast here with a little bit of analysis of precious metals. We saw a huge intraday reversal on gold and silver when the mainstream Wall Street people and the mainstream Keynesian people got shocked, right, about the no taper. We saw gold and silver gap up. Some of the miners, Mo, went up 20%. I was watching this live at my full-time investment analyst job. And, there were people in the office who were mainstream Keynesians, and they were thinking about trying to bet on the amount of taper, and we were just laughing about that. I was just laughing about that because I thought that they probably wouldn't taper, and if they did, they would have to reverse it anyway. But anyways, though, Mo, we just had a strong intraday reversal, and some of these juniors in an hour or two were up 20%.
And yeah, and the day after that, it pulled back down to almost, not close, but almost to where it was before the Fed announcement. So, it's the same old story once again.
Yeah, I think it was a combination. Sorry to interrupt you, Mo. I don't know if you agree with this. You can tell me what you think in a second. But I think it was a combination of some traders who actually understood what we were saying. So maybe they positioned themselves for a short-term trade to be long gold, silver, and the miners before the announcement. And they took, 20% in a couple days is a huge gain if you're a trader, especially if you're on leverage, because that 20% gain without leverage is going to be even larger than that with leverage if you're leveraging a position. So I think it was a combination of profit-taking and manipulation, because I think like gold broke that 1350 overhead resistance level that used to be key support, and it turned into resistance, obviously, if you know technical analysis. When something goes down, the trend switches, and what used to be support becomes resistance. Gold broke through that. It looked really good, and then we're back down again, despite the fact that and the Fed's now saying rumors that, we may taper next month. The Fed has a horrible track record, right, Mo? When has their predictions been accurate? When have their models been accurate?
Never. They said back in 2000, they said the housing market wasn't in a bubble, and it wasn't a bubble. Then, before they did QE2, they said they're going to do an exit strategy because they think the economy is doing well, and they ended up not doing an exit strategy. They ended up doing QE2. And then recently they said they're going to taper, and then they never tapered. They kept it going. And so don't expect the Fed to taper anytime soon. So keep buying gold and silver at these levels because it's still a bargain. One day it will go up. I don't think it's going to do much for the rest of this year, unfortunately. We may see silver go above 25 and sit around 25 and 26. And for gold to go above 1400, between 1400 and 1500. But I think that's it. I don't see a big rally anytime this year. And a lot of people out there are predicting that after 2015, that we're going to see a big rally in gold and silver like we saw a couple of years ago. So we'll see what happens. So and I could be wrong. It could spike up again and go above 30 or go above 1500. You should never know, because we could have a war in the Middle East or another black swan event that may cause gold and silver to go up.
Well, Mo, in terms of the supply-demand fundamentals, the fundamentals just continue to get stronger. You just have demand for physical continuing to increase. China is definitely buying around 100%, if not more, of annual mining supply just from China. And we don't even know all the statistics of how much physical metal China's buying from Australia, China's buying from Switzerland, China's buying from New York, China's buying from Canada, China's buying from other parts of Europe. all these in different parts of Asia. The only statistics we have for Chinese gold demand are how much mainland China is importing from Hong Kong. That's it. And I guarantee you China buys gold from other parts of the world.
Oh, yeah. I'm sorry. Yeah, especially from the miners in Canada and Mexico. I think they're doing a lot of deals with them as well to get the gold and silver.
Exactly. And I just heard Jim Rickards talk about recently, and I actually sent him some emails about this last night, and I got some answers back about this, but that the Chinese actually, after the April takedown there, the smash in April, the Chinese bought they bought 600 tons of physical gold from the Perth Mint. And the price just kept going down. 600 tons is a humongous order.
Yeah, especially if you look at the annual mining supply for gold, which is around, I believe, is it
it's like
1,000?
The annual mining supply is around, I think, 2,200 tons a year, but but China produces a lot of that, and Russia produces a lot of that, and they don't leave those countries. The production doesn't leave. So I believe only about 1,400 or 1,500 tons per year is available for the market. That might be a little high, too. And China's buying a lot of that, too. China's buying most of that, too, if not all.
And you're still seeing the big divergence between the paper and the physical market.
Yes.
If you look at the physical market, it's saying that the price of gold and silver should be higher than what it is today. But the paper market, because it's very manipulated, is telling you another story, which is completely inaccurate.
Exactly, Mo, and this is just killing the miners because their costs, like some of them have been able to lower costs a little bit in the last few months, but overall, as a long-term trend, their costs are still rising. There was a good study by Steve Santangelo over at SRS Rocco Report, and he said that since 2005, it used to be in 2000. Start over again. In 2005, it took the top 11 primary gold miners in the world that are publicly traded about 11 gallons of diesel fuel to produce 1 ounce of gold, and now it takes them 25 gallons of diesel fuel to produce that same ounce of gold. So those are costs that they really cannot cut. There might not be new technology available in order for them to switch to that type of, because they already spent hundreds of millions, if not billions of dollars building out that mine. So this is a situation here where if the market is going to demand more physical gold, the price is going to have to bottom very soon, and it's going to have to start going higher. Because eventually, Mo, the fundamentals, the laws of supply and demand will eventually have to be accurate.
Yes, and also the cutoff, you've seen a lot of the cutoff grade for the miners continue to go up, where they can't mine anything that's below this number of ton per,
grams per ton.
Yeah, grams per ton.
Yeah, so they're raising their cutoff. For listeners out there, very, very brief summary. The miners are so worried about margins, profit margins, because even at these levels, because we've had a relief rally, obviously, since the lows at the end of June. We've had a rally, short covering and other stuff, people going long. But even at these prices, a lot of miners still cannot make money, so they are scrambling like crazy to cut costs any way they can. And that means the lower grade ore, the stuff where there's no margin, that stuff they're gonna put it in a pile, and they're not gonna mine it until the prices are way higher.
Yeah, and I was listening to an interview from Brent Cook, and he said a lot of the miners are looking for more high-grade deposits rather than low-grade for merger and acquisition, because those mining sites are more likely to make money rather than the mining sites that have lower grades. So that's going to take a lot of gold and silver offline and off reserve for a lot of these mining companies, which should make gold and silver even more bullish.
Good point, Mo. So let's wrap up the podcast here. Let's summarize some of the points we mentioned. We talked about the reasons why the Fed can't really do a significant taper, and even if they try a short token taper, I guess I call it, as a stress test or something like that. There's a lot of reasons why the Fed really can't take the money out of the system. On top of this, the entire economy all over the world is still over-leveraged. So any rise in material rise in interest rates is going to start creating potential bankruptcies, failures, things like this.
And yes, and also because of the large balance sheet that the Federal Reserve has, there's no way they can taper. So we're going to expect them to continue to print money, and because the economy is not going to get any better.
Exactly, Mo. And remember, the Fed was talking about exiting in 2013, a couple years ago, 2014, now, and then they pushed out to 2015. Recently, after the no taper announcement this past week, they said 2016 is now their new exit strategy because the economy is so weak. So
Go ahead.
Yeah, so basically, it's dependent on their data, and their data is all bullshit. Their data is all bullshit. The real economy all over the globe, including Japan, is stuck in one degree or another of stagflation. Some countries have it worse than others because, especially, we covered this in a previous podcast, the developing countries, they have really bad inflation. The inflation here in the developed world is not as bad as in India or Brazil or those places, but it is starting to get worse, though. And then, we talked a lot about the jobs market. So, yes, there are some industries like technology and shale oil and some manufacturing jobs that are doing pretty well. The problem is with a lot of these industries, they're not big enough to offset people losing full-time jobs in larger, more established industries. Whereas, for example, Mo, with the 3D printing industry, yes, that industry is growing, I think, at a over 30% compounded annual growth rate, right? But I think the industry is only like a $10 billion industry, right? And some of the industries it's replacing are worth a couple trillion. So...
Right, and also all the jobs that are coming back to U.S. and manufacturing jobs, a lot of them are coming back, but they're being replaced by robotics and automation. So even though they're coming back to the U.S., it's not going to show up in the employment numbers because they're using robotics and a lot of other technologies to cut costs and make things more efficient because with stagflation, a lot of companies are focusing on cutting costs and protecting their profit margin.
Exactly, Mo. Exactly, and those factory jobs, like in the old days, there used to be factories that had over 5,000 workers there, and that would really be beneficial to the town because there would be a whole bunch of other support jobs for the factory and then restaurants and those things. But the factories, which are very expensive and automated, that are being brought back here to the United States, like auto ones and stuff like that, they might only need 500 to 1,000 workers, if that. And yes, it is productive long-term for the economy, and it's good if you're in that town in South Carolina or Tennessee. There's going to be a lot of jobs around that area, like support jobs, in addition to the higher-paying factory jobs to cater to the higher-paid workers. But that's not enough when there's millions of underemployed or unemployed Americans that are looking for jobs. So I don't think Jim Pavlova is fully adding that up.
Right. And then we also talked about how technology stock would be a good inflation hedge because the technology industry focuses on producing products and service that cut costs for other corporations and big businesses that are looking for ways to actually cut costs. So, and in the era of inflation and stagflation, that's very important. And so people might want to look for technology stock, not for value play, but for growth. So
exactly, Mo. Now, while these other sectors, these larger, more established sectors, are stagnating or contracting, right? The technology sectors will still be growing. I expect them because more American. One example of this is with biotech, right? There's more Americans that are fat and sick and not healthy, right? I expect more Americans to continue to look for solutions in biotech with new drugs and things like this, to look for taking one pill rather than completely changing their lifestyle. Like, Mo, how I'm eating mostly low carb and paleo now. I don't eat a lot of gluten anymore. I don't expect most people would not be willing to do changes like that and, radical changes in their life, even if it made their life better in the long term. So most people are going to be looking for a more, I say efficient solution, but in certain cases it'll be efficient, in certain cases it won't. But in terms of biotech, like taking one pill to make yourself healthy when your whole problem is a lifestyle change because you don't exercise or work out or anything like that, and you eat bad foods, taking one pill to solve your problems is not a good idea. But in general, though, technology will make the economy more productive. People do more with less. It will make the society more efficient. The problem is with technology, Mo, is creative destruction. Okay? It changes the economy so rapidly now. We have so many new technologies out there that if you're a student and you thought you were going to get a high-paying job and you just took out a big student loan, or you've been working in an industry, for 50 years or 30 or 40 years, right? And then all of a sudden the industry changes because of new technology and you're out of a job. Just people are not adapting to how quickly technology is changing. So that's a problem. The individual, in my opinion, that's not something the central planners should be solving. That's something the individual should figure out, get more skills, save money just in case you lose your job, things like that.
Right. And the last subject that we talked about was gold and silver. And despite the
no taper
pullback that we had in the past week, the fundamentals for gold and silver has not changed, has got stronger. The demand is still high in this country and overseas as well, in China and India. So we think people should continue to buy at these levels. And
but Mo, the caveat with the physical gold, that we got to make the distinction here. Physical metal is not an investment, though. Physical metal is just for insurance and wealth preservation. So if you have 10 grand, this is an example. If you have 10 grand in your checking account, right, you should probably have 1,000 or 2,000 of that 10 grand in metal stored outside the system, just in case the banks decide to do the Federal Reserve, right? They're not getting enough inflation. They decide to close the banks down and do a devaluation, or the bank that you have your money at, they're trading derivatives, right? Leveraged, like they're pulling a MF Global, or they're doing like a speculative derivatives bet, and they steal your money on a bail-in. So I think just from an insurance perspective, the thing about insurance is you hope to God you never use it, right? You hope to God that your house doesn't burn down or your house doesn't get destroyed in a tornado or an earthquake or a flood, right? So you buy insurance hoping to God you never have to use it. And that's where one of the things where precious, like physical gold, physical silver, a little bit of platinum or palladium fits into the portfolio. I don't consider those an investment. Some other people do. I don't. I consider that portfolio insurance for your other investments, for your mining stocks or your dividend stocks or your real estate or your technology stocks.
Right. Yeah. I agree. Yes. Gold is an inflation hedge. It's an insurance just in case the fiat currency collapse. Same for silver as well. People call silver the poor man gold because people that can't afford gold can go out and buy silver as well. Despite silver being an industrial metal, it still has property as being money as well. So that's all we have for tonight. And until next time, everybody can tune in for all our podcasts at www.wallstreetformainstreet.com. I forgot it. I wanted to mention that. And also, you can check our podcast on YouTube as well. So, Jason, thank you for joining me.
Thanks, Mo. And if our listeners have any questions or they want a free copy of our oil report, they can, or they have any other ideas for suggestions for podcast guests, because we have some big-name guests coming up like Dr. Mark Faber and others, they can email us at wallstreetformainstreet@gmail.com. That's WALLSTFORMAINST@gmail.com.